and welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on the energy sector, and my guest is David Sekera, Chief US Market Strategist at Morningstar. Well, authorities around the world are scrambling to fill a yawning power supply gap as an energy crunch grips global economies. China's government has ordered miners to ramp up coal production as power prices surge, while some states in India are experiencing blackouts. A shortage of natural gas in Europe has sent energy prices skyrocketing, while industrial leaders in Britain are warning soaring wholesale gas prices could force factories into sudden shutdowns. The pace of economic recovery combined with cold weather have increased demand for energy and pushed up the price of oil, with Brent crude now almost at $84 a barrel, within sight of a three-year high. The sharp rise means OPEC Plus has come under pressure from consumer countries, with the White House saying it wants the OPEC countries to pump more fuel. After tumbling in 2020 when oil prices plunged at the start of the pandemic, the S&P Energy Index has gained 50% since the start of the year. But is there more upside to come? Let's ask David Sekera, Chief US Market Strategist at Morningstar. Hi David, thanks so much for joining us. Now, I know that despite that recent run-up in commodity prices, you still think the energy sector is undervalued. Why is that?
Yeah, we do think that. And right now, based on a composite of the intrinsic valuations of the companies that we cover, we think energy just generally is about 10 to 15% undervalued. And while you mentioned it is up, 50% year to date, and I think just in the past month, 20% alone, we're really looking at the long-term value of these companies. So while, we've certainly seen oil and natural gas prices, just skyrocket here over the past, couple of weeks, we're really looking at the valuation of these firms over the long term and really throughout the entire business cycle based on our long-term forecast for oil and gas and the amount of demand over the next 10 to 15 years.
So what do you think the long-term impact will be of the energy crunch that we're seeing right now? Is it simply transitory?
Well, we think so. So, there's a confluence of a number of different factors that are going on. Now, those individual factors are slightly different for exactly what's going on in the oil market versus what's going on in the natural gas market. But we do think that over a couple of years, we should see, a lot of more infrastructure being built, new projects coming online, which will help be able to even those out. But specifically thinking about what's going on in the oil market, we do see a little imbalance right now with what's going on with OPEC. They've been having some difficulties over the past couple of months getting their production levels back up to the quotas that they've targeted, and we think that may continue over the short term. And in the natural gas market, we've just seen the prices there, just skyrocket because there really isn't a lot of excess supply globally in the natural gas market. And so with people looking to be able to build their inventories going into the winter months, we had a couple of months of, lower than usual wind generation in Europe. So inventories are lower than people wanted them to be. And now they're scrambling to be able to go get that going into the winter months.
It seems surprising, though, nevertheless, that the White House, for example, is trying to put pressure on OPEC to pump more when it's supposed to be transitioning the US economy to use much less gasoline. So going forward, how will hopefully soaring demand for electric vehicles influence oil demand?
And it is an interesting fact right now that we actually have above consensus view as far as the percentage of vehicles that will be electric vehicles by, the year 2030. So by then, we think for new vehicle production globally, at least 30% will be electric vehicles. And then another 37% will be hybrid vehicles. Now, having said that, when we put together our demand curves for the long term, we're actually on the high end of consensus for the amount of oil demand for the next 10 to 15 years. And so I think a lot of people are either not looking at it quite correctly in that they, are maybe thinking there's going to be less miles driven, or maybe they're just not necessarily modeling out that cars just last a lot longer nowadays than they do in the past. And only a couple % of vehicles today are electric vehicles, whereas the ones being built today are going to be on the road for, over the next 15 years or so. So a lot of, the reason that we think the market is undervalued is because we do expect demand to stay high, at least till 2030 before we start seeing some of that gasoline demand starting to dwindle.
Energy companies perhaps haven't been the most fashionable investment in recent years as ESG concerns grow, but we're seeing a big impact in the sector now from activist shareholders who are using that to pressure the way that the companies behave, aren't we?
Oh, we definitely are. Investors are definitely becoming increasingly more active using their shareholder votes in order to persuade management teams to balance their growth plans, really balancing, between the shareholder interests as well as the environmental concerns. So a lot of things that, we've been hearing about management teams spending more of their time focusing on efficiency programs, looking to do things like, reduce their methane emissions, reduce the number of flarings that they have, but then also looking at other emission abatement programs as well, such as carbon dioxide recapture programs. Now, engine number one in the proxy fight with ExxonMobil is certainly the most high-profile example of this, at this point in time. And I think Exxon for too long had spent too much of its capital on acquiring oil and hydrocarbon assets over the years. It really needed that kind of better capital discipline, in order to balance their growth plans over time.
Thanks so much for that. That was David Sekera, Chief US Market Strategist at Morningstar. Well, before we go, here let's have a look at some of the stories making headlines in the energy sector. China is to allow coal-fired power plants to pass on the high cost of generation to some end users via market-driven electricity prices. At the moment, most industrial users there pay fixed prices to state-owned grid companies. The aim is to increase energy supply as a power crunch forces factories to curb production. Meanwhile, in India, the government has directed suppliers to pump more energy to the capital, Delhi, after blackouts in much of the country. Russian energy giant Gazprom says it's using its stockpiles to pump more natural gas into the European market and stabilise prices, rejecting the suggestion that Russia is deliberately withholding gas to push the German authorities to approve its new Nord Stream 2 pipeline. The European Union said today it's working on plans to ensure Ukraine has a steady supply of gas this winter, amid concern in Kiev that the new pipeline makes it easier for Russia to cut supply. And the French President Emmanuel Macron has unveiled a €30 billion investment plan today aimed at making the country a green energy champion by 2030. He said France will build 2 megafactories for the production of green hydrogen, develop a low-carbon plane and far more electric vehicles. Contrary to the demands of some environmentalists, though, the strategy does call for building new nuclear reactors, which produce the bulk of France's electricity. And that's your roundup of the energy sector. I'm Elena Casas, and this is Reuters.